Now, most people will think, well, we survived the COVID crash. We had a great rebound. Then we had another sort of mini crash last year, which we seem to have recovered. But we're dealing with a situation of persistent inflation and the possibility of higher interest rates yet, possibly precipitating another major market meltdown. And the hurricane people are fearing is a raging bear market. And, you know, it's easy to understand. If you look at what happened in 1980 when we had 14% inflation compared to what we have now, we ain't seen nothing yet in terms of what the Federal Reserve could do to us in terms of tanking the market and ushering in a recession and perhaps even a depression. But that's not what I'm talking about. The eye of the hurricane I'm talking about is we're in this transition zone from a 10-year-long resource junior bear market heading into what I believe will be a 10-year-long raging resource junior bull market. Now, before I really get into explaining why I think things are going to really take off in the next 3 to 4 months, I'd like to talk about something called the PDAC curse. And this is this phenomenon that, when the new year starts, we pick ourselves up, and after the companies get creamed with tax loss selling in December, we get a new year round of optimism. It climaxes at the biggest international mining conference in early March in Toronto. And then, because everybody's heard that you should sell in May and go away, almost every year, immediately everybody preempts the May sellers and it starts trading downwards. Now, there have been exceptions, violations to the PDAC curse. The first one that I observed was 2003 when gold started to turn up, and early birds like Robert Friedland were talking about the China super cycle. And the next one took place in March 2006. And that's when the majors finally understood what Robert Friedland was talking about and stopped forward selling all their production into a backwardation market that kept rising. Then the next one was in 2009, and this was after the crash, and nobody expected anything good for a long time, but China came along and did a $600 billion infrastructure spending spree as part of their fiscal stimulus. And the Americans decided not to really do that. They went onto a quantitative easing binge, which helped gold up to $2,000. So that year in 2009, right after PDAC, it just kept going, and that we had a pretty strong market until 2011. Then, when the Tea Party got control of the House in late 2010 during the midterms and started the debt ceiling extortion, it basically stopped the United States from embarking on an infrastructure renewal campaign, and everything kind of went sideways, and we just had that miserable bear market. Now, in 2016, it looked like gold was finally coming out of the gutter, and we had the PDAC curse violated. In 2017, also, it was started to be a little bit, but it pretty much fizzled. Now, then came along the weed and crypto booms, which pretty much took away all the risk capital, and the resource juniors stayed in the dumpster. And the last few years, the PDAC curse hasn't been relevant because COVID hit after the PDAC 2020 and tanked everything. And then there was a virtual PDAC in 2021, which didn't count. And last year it was in June when everybody had already sold for May, and so there was no meaningful PDAC curse. This year, I'm expecting that the PDAC curse will be violated. Now, this chart, I had an older one. This is the old PDAC curse chart that I used to have, and it was around 2017. It was sort of showing strength in the market that I wasn't feeling. And I said, something's wrong, because my juniors that I cover, they're still in the doghouse, and yet the TSX venture trading value and volume is way up. And so I ended up separating out the resource listings from the non-resource listings, and I realized, my gosh, we are still in a bear market. The non-resource stuff has completely taken over the share of the risk capital that flows into the TSX venture exchange. And this changed in December of 2021. We have now been consistently above 50% of the traded value of the TSX venture market. And this trend is continuing. Last year basically was the definitive death of crypto and cannabis and all these other things. And the numbers are actually better because there's a $70 real company from Europe that's got $100 million revenues that trades as on the TSX venture for some reason. So the amount of real money, risk money going into the TSX venture is now over 70% of the traded value. So here are the two drivers that I think are going to be the foundation of a resource junior bull market, and there's really nothing the resource juniors can do to screw this up. The first is the energy transition. All these energy policy goal, net zero emission policy goals that the government agencies have established. This is going to require substantial new supply in a number of metals. Then there is also the showdown between autocracies and democracies, with China and Russia forging an alliance. And this has two consequences. One, it's going to be good for gold as the autocracies figure out a way to escape the US dollar weaponization that the United States has undertaken. And the other is, if this conflict escalates into even a war between the United States and Russia or China, we are going to see serious disruption of raw material supply, and this is going to change. Like it's basically deglobalization. It's the world fragmenting into separate economies, and this is going to be a huge problem for the Western markets. Now, first with gold, people talk about gold as an inflation hedge, but if you look at this way back, if you took gold way back in 1932 or so, and when it was changed to $35 and inflation adjusted, it should only be $300. Now, you can argue that the inflation numbers are all bogus, but they're probably not. If you take $400 in 1980 after the big reset, it should be now at $1,525, which is pretty close to where we are 1800. So we are seeing a higher real price. The name of the game for gold is a higher real price. This is what lowers the grade bar that you need for something to be worth developing. And the reason gold is going up is because it's a hedge against uncertainty. And now we have the autocracy central banks starting to buy gold rather than US T-bills, and that's going to clean up a lot of the gold that's in the system, and it's going to be a bridge for when they develop their own currencies that they're willing to trade if we end up with this deglobalized economy. So I'm optimistic that we will continue to see gold go up on a steady basis, outpacing inflation itself. And gold as an inflation hedge is not interesting to the juniors because the costs of everything are also going up with inflation, so you don't end up better off with a higher gold price. That's simply mathematically reflecting inflation. And of course, the big conflict is China's economy converging with that of the United States in terms of size. India is still sort of bumbling along, but it looks like by 2030, they will hit that tipping point that China hit in 2003, where they're somewhere between 3 and 4% of the economy. And given the demographic problem that China has, which India does not, that's going to be what might extend this bull market beyond 2030 into the 30s as India becomes the next super cycle. And here's why this conflict, this autocracy-democracy showdown is a problem. This is the share of the metals supply that Russia and China combined represent. It's incredible how much metal comes from these two autocracies. And what I've done here is with the same scale on the left is showing Australia and Canada at the top, United States in the bottom left corner, and India in the bottom right. And just for comparison, I've sort of pasted the Russia-China one. This is a huge problem coming if peace and harmony do not invade the world and Russia retreats from Ukraine and everybody stops fussing with each other. And this is going to be a sweet spot for Australia and Canada because they have an enormous bounty of resources that has been underexploited because the world has preferred to get its raw materials from the environmental shitholes in the rest of the world. And these places are terrible because they're run by autocracies where the downstream victims have no say. There's nothing that they can do to protest when the oligarchs dump all the emissions. One of the positive things that might come out of deglobalization is that that will simply not be available anymore. So the big thing that the governments in Canada and Australia, ideally in the United States, is to streamline and fast-track their permitting system. Do it right. We've learned in the last 30 years how to do it, but do it fast. So the other thing is the requirements for the net zero emission goals. And this is a report which you can get from the International Energy Agency. Downloads about 450 pages. They map out how they see this future unfold. What matters to us is not what 2050 is all about, but 2030. And you can see that they see the solar and wind development, which isn't that relevant to us juniors, is going to be important, but it's the electric vehicle rollout. Now, the governments have created all these mandates that require a certain number of cars to be electric vehicles, and in Europe at 2035, it's zero internal combustion engine cars. Now, this report's really good because what they've done is they've analyzed that if these dreams are to become reality, how much more metal will be consumed for these scenarios. And you can see there that lithium is a huge problem. And this is stacked on top of what's already being used for the macroeconomy as it continues to grow. And here is the simplification of it. They need 600% more lithium to build those lithium-ion batteries for 2030, what they expect to be the portion of car sales that are electric vehicles, and 50% more copper than what's used for everything else, 100% more nickel, 50% more cobalt, though that's questionable because everybody's working hard to substitute out of it, and neodymium, which is sort of the important magnet in the rare earths, 100% more. So here's what's happened in the lithium space in the last while. Most people don't know that in 2005, the lithium market was worth only about $200 million. It is the reason that there is this huge problem. Last year, it came in at $49 million if you use the average lithium price. The reality is lower because a lot of lithium was already sold through long-term contracts at lower prices. But what happened was in 2015-17, which I call Lithium Mania 1.0, when people started to see that Tesla is real, electric vehicles are real, we had the first boom, and you can see the Australians were the ones that rose to the occasion, looked up all their pegmatite deposits that had been documented while looking for gold and precious metals, and acquired them and started advancing them. They were so good at it that they oversupplied the market. They were faster than what the EV sector happened. And so this resulted in this crash right here, which effectively stalled all these lithium projects that were at various stages of feasibility demonstration, because at $3 a pound, the stuff doesn't work, especially the pegmatites. You're not going to put anything into production. But by 2021, the market realized that the electric vehicle industry had ignored Trump's efforts to eliminate the fuel efficiency standards and had made an irrevocable commitment to shift to the electric vehicle sector. And all of a sudden, we had the reverse happen. The demand was greater than the supply. So we had this insane run, tenfold increase to $30, $35. That's not sustainable, and it's now being reversed because the supply has responded. The Australians are back at it. Other projects are coming on stream, and the brines are also starting to finally move forward. So everybody hates a chart that looks like this, and we've seen it a number of times in the past. This is a good chart. It should go down to $10 to $15 a pound, because at $30 to $35 a pound, any crappy pegmatite is in the money. So you want to see the good ones develop, not the fake ones that are ultimately going to oversupply and crash the price. So do not be afraid of a continuing downdraft in the lithium carbonate price. And in the longer run, if you want the masses to have cheap electric vehicles, you don't want staggeringly high lithium costs to put the car, make them unaffordable for ordinary people. And so here's a good way of looking at it. Most people don't understand how to quantify the value of a pegmatite that has such and such a grade. So I've created a little matrix showing what at these different grades and different prices, what the rock value is. This has been the rock value for the past year. And of course, it's not sustainable. This is like the equivalent of 1 to 2 ounce per ton gold, open pitable, tens of millions of tons. I mean, this doesn't exist in the gold world. Even if it sinks back to 10 to 25, this is the sort of range for the types of deposits that you're going to find. And this is like a third of an ounce open pitable, and you're talking large tonnages. Now, when you expect lithium to go from 600% to up 600% by 2030, that's 700,000 tons. Last year, it was 130,000 tons of lithium metal that was produced. And here's the breakdown of where it comes from. Now, I missed the first lithium boat because I assumed the Chilean, the lithium triangle in South America, SQM and them would simply, milk more brines for lithium, supply whatever the market needed. It hasn't really happened. It started to happen, but you can't advance this as quickly as you can a pegmatite. This is what the Australians did, and which is why they tanked the price. And China's working hard too with both brine and pegmatites, but it doesn't have the quality that the lithium triangle and the pegmatites in Australia have. So where is it all going to come from? The map on the left is, this is the potential brine from oil fields. Requires direct lithium extraction, which is a technology story that has to still be demonstrated. The car companies can't count on it working. This is the claystone. We've seen in the past month, the Department of Energy loan $700 million to Ioneer for Rhyolite Ridge, conditional on getting permitting. And GM has invested $650 million in Lithium America's Thacker Pass project. These are the claystones in Nevada. And of course, Australia is the big supplier on the pegmatite stuff, but this is where the extra is going to come from. Brazil also. Africa, there's lots of potential there, but Africa is unstable. And Scandinavia has potential also. But this, Canada and the United States with its NIMBY problems, not much going to happen there. But this is now the big boom where the second half of the 600% expansion is going to have to come from. And right now we have a 2 to 3 year window to find all these things, drill them off, delineate them, and show what's available, and then spend the 4 or 5 years what it takes in Canada to do the feasibility demonstrations, simultaneously get permitting done so that that required supply becomes available in 2030. And we're talking S-curve territory, not like, okay, we already know that we have 50 million tons and what's it going to cost and blah, blah, blah. It's no, like we have nothing except showings and stuff. What is actually there? This is what's going to create a what I call Lithium Mania 2.0, and it's also going to create for the first time since the 90s, a great Canadian area play. And I don't have time to get into all the reasons why it qualifies, but one is that you don't know exactly where these are, and so the mapping may be incorrect, the showings, you don't know whether it's LCT or not, but now this whole area is being staked. The cannabis promoters are getting their shells in there. Everybody is in there. The ambulance chasers are there. But there's the Australians. Now, the Australians, they are awake. The Canadians are asleep at the switch. They don't understand that. Australians' money is coming in and bankrolling these projects. And this will end up being wall-to-wall staked. And then when the Canadian markets in that wake up, there'll be huge inflow of capital to fund these projects. And it's going to be great for the James Bay region, which has always been looked for gold and base metals, but has never really delivered proof that there is a world-class endowment to it, but it has a world-class endowment of lithium-enriched pegmatites. This is going to become a monster lithium supply district. And here's going to be the Canadian poster child. These guys in 2015 had the Corvette project. In fact, they were at a MIF conference because they were next door to Midland's mithril copper play, and by then the lithium prices had collapsed to below $3 a pound, so nobody cared. But during that period, they reorganized the company, and that financing that came in 2021 and was Australian money. The Australians got it. They could see they were going to repeat exactly what they had done in Australia and the Pilbara and all these places where all these worthless pegmatites had been documented as a byproduct of exploring for gold, precious metals, and base metals, and they were going to bankroll this. And Patriot Battery has a $2 billion market cap now. Now that's huge, and it's got a 50-plus kilometer trend, multiple showings of what appear to be LCT pegmatites, and the one that they already have got 100 holes into, it's got a 2-kilometer segment where you can see 50 million tons, and there's reason to believe that as they march the drill along the lake, there's another 50 million tons. So 50 to 100 million tons of what's going to be 1% to 2%, and depending on what long-term prices you're talking about like a 50 to 150 billion dollar in the money endowment of lithium just in this one project. And the big companies, they all like big markets. If we have 700,000 tons of lithium metal at a minimum $10 a pound, which is what's needed to make it reality, we're talking about a market that's going to be $100 to $200 billion. That puts lithium in the league of copper and gold. And the big mining companies are not part of it. There's like $14-16 billion companies like Pilbara Minerals and Mineral Resources that have emerged out of Australia. They might become the contenders. But the Rio Tintos, the BHPs, the Anglo-Americans, if they want a piece of this lithium future, the James Bay region will be a major place to go. Now, other parts of Canada may have similar potential. This is the one that's just most advanced and obvious. The big event that could happen by the end of the year, maybe we'll have to wait till a resource estimate's done and sometime in the second quarter, is this simply gets taken out by a big company. And if we have suddenly $2 to $3 billion of capital injected into the genes of these Patriot shareholders, where's it going to go? It's going to recycle into the system because the pegmatites that are there on the Corvette project, it's not enough to take care of the world's future supply. We need many of these 10,000 ton per day mines to supply the future. So this is not a game like rare earths where you want everybody else to fail so that the market doesn't tank when all the supply hits it. We need a massive expansion of many success stories. This is very similar to the diamond play of the 90s, which in my mind was really the last great Canadian area play. And the first three companies three of the companies in my session are James Bay lithium explorers. And last year in June, Brunswick Exploration was here. It was 15 cents. Less than a year later, it's over $1.05. And they had a strategy of, Bob Wares woke up and saw this, understood the energy transition requirements, saw that the lithium price had come out of the garbage can, and said, oh, I'm too late for this game. All these other clever geologists must have staked everything. And he went through the archives and everything and realized only postage stamps had been put on lithium deposits here and there. So Brunswick developed a strategy of researching the archives, finding all these documented pegmatite showings and trends that nobody ever assayed or did anything with because it was worthless, and then started staking the land, going into the field with an XRF gun, immediately discarding the ones that were no good. And interestingly, this property here, Plex, they got it from Osisko, who got it from Virginia. Corvette, Patriot got Corvette from Osisko, who got it from Virginia. Virginia was looking for gold and had staked these trends for orogenic gold. The orogenic gold is not related to the lithium pegmatite potential, but they would, in the case of Plex, they literally drilled through pegmatite, didn't even bother assaying it because they were after the Orphy zone. So now there's this scramble, like all this stuff that we ignored. Is it lithium enriched? And the complexity of everything the James Bay region is, there'll be some companies, some areas where you can say it has zero chance of a success. But in a lot of these areas, the most horrible, worthless little junior could end up actually having staked something that's very significant. And that's part of the mystery of a great Canadian area play. It isn't like Robert Friedland's Diamond Field staking all the Tassie-Uac Nisus surrounding his discovery there in Labrador, and everybody else just drilling staking the anorthosites and hoping on the anomalies are going to be an ovoid. No, this is a completely different thing. So Brunswick, with Patriot listing on the ASX, its now daily trading in Canada is basically shaped by what happens in the earlier ASX session. Brunswick is now becoming the alternative to Patriot for the Canadian or the North American and European investors. And yes, they are behind, but they have similar land package. They have multi-pronged land package. They continue to acquire additional ground. So this is the sort of keeper in this play where you just buy it and forget about it because it could end up being another 10-bagger from the current level. Now, other companies that have been in this area are Sirius Resources, which outlined a 2 million ounce resource at the Chichu project. It's a low-grade system. It doesn't quite work at the existing gold price, and it needs to be consolidated with the neighboring ground so that you can expand the pit shell and include mineralization that can't be in the resource estimate. So this could be a potential 3 to 5 million ounce system. And so it offers you gold optionality on a higher gold price, but also optionality on this becoming a major lithium district as infrastructure gets pushed into the central part of Quebec and the whole transportation issues and all that, they cease to be a remote problem. But here's the fascinating thing. They have pegmatites all over this property, and they even picked up spodumene-bearing boulders while looking for gold. And so they've recently expanded the property to include the up ice portion where it overlaps between a geological domain boundary, which seems to be a favorite place for these pegmatites to come up. And they've since gone out and used database-based methods to stake additional projects. And this is something to watch out for, is what is the method these companies that are picking up land using to identify targets that have real geological pegmatite potential. And Harfang is also in this region. They've been there for a while. It's kind of Andre Gaumond's successor to Virginia Mines. And they've been focused mainly on gold exploration. They merged last year with LaSalle to consolidate the Radisson Serpent project, which, there's a huge golden till dispersal apron there that remains to be properly explained. And they're drilling a gold target, Lake Minarek, right now, which could deliver a discovery over the next 3-4 months. But Ian Campbell is, he actually was the VP of exploration for the big whopper pegmatite that Avalon discovered in the Separation Rapids area in the late 90s. So this is an example of somebody who already understands how the pegmatite world works, whereas everybody else, not everybody, but many of the geologists are now looking it up in the textbook, just like they did with the diamonds in 1993, when all of a sudden diamonds were the thing, but nobody knew a thing about it, but they sure found out quickly. And in terms of where we are in the Great Canadian Area Play, we are still very early days. This is like, Diamet announced its diamondiferous stuff here. This was the year of staking and positioning by all the juniors. And then it was only in the second quarter where Diamet went to $60, and the juniors started finding diamondiferous kimberlites outside the We Got It All ECADI project. We are ahead of this, and I think this is kind of where we are 5 years later, and I think the lithium is going to drive the eruption of money coming into the sector as people get their heads around it, and it will wash over into the other parts of Canada that have pegmatite potential, and also as people start to understand this critical minerals requirement for 2030 and the supply disruption that's possible because of this geopolitical conflict. This is going to really put the resource juniors back on the public's radar. And then I mentioned rare earth earlier. Rare earth mania was crazy in 2009 when China, or 2010 when China first used it as a political weapon, and the prices went crazy for these rares, and eventually this resolved itself. But back then, rare earth supply was 100,000 tons, and since then it's tripled to 300,000, and the IEA is saying we're going to need 600,000 tons of rare earths. Now, only 20% of this is actually usable rare earths. It's the magnet rare earths that are key. All the rest is basically like a waste product. So China still dominates. Wind turbines and that still need these magnets. This is going to be, I think, Rare Earth Mania 2.0 is coming. It's much more complex and difficult than pegmatite, but that's also an area to be interested in. And this is why the other two companies, Endurance Gold and VR Resources, in the case of Endurance Gold, their flagship story is a gold play, a reliance, but they also have a syenite intrusion in southeastern Yukon that has fantastic rare earth and even niobium values at surface. They looked at it just as the rare earth mania was dying, and it's basically been fallow for the last 10 years, but they potentially could revisit that. And what's sort of wild about it is the heavy rare earths, which are these two, terbium and dysprosium. Even China has a supply problem with those. These are the ones that are doping agents for the neodymium and the praseodymium in these magnets to keep those magnets from losing their magnetism at high operating temperatures. And VR Resources, while looking for IOCG deposits in the James Bay Lowlands area, they ended up discovering a system that has monazite zones that run between 1% and 2% in it, which interestingly, they actually have they also have about 8 to 10% share of terbium and dysprosium. Most of these monazite-based systems and bastnasite-based systems do not have any of the heavies in. So deposits like this are interesting if you can figure out how not just get the neodymium and praseodymium out, but also get the terbium and the dysprosium out. So this project is kind of now in the delineation stage, trying to figure out what the geometry is. And then here's sort of your teaser for next year when you're here. While drilling another one of these intrusive target, what they hoped was an IOCG or something similar, carbonatite or something like that, they hit what turns out to be a kimberlite, a blind kimberlite a huge kimberlite. It's undercover. Nobody could ever have seen this through till sampling because it's never been scraped by glaciers. De Beers and everybody. In November, I basically did a swan song for diamond exploration saying there's no clusters left to be found. The Canadians have done a great job till sampling. If there's any clusters left, they would have been found. And this was a mag low, and it's huge. It's 1,000 meters wide. This would be like a Joannec. We don't know if it's diamondiferous. It's in that part of the Kappas casing structural zone, which was thermally hot between 2 and 1 billion years ago. So any diamonds that were there before that are gone. But Victor, which is farther to the northwest, it has 700 million year old diamonds. And there's evidence of eclogite in this suggesting subducted ocean plate went in there, and it's possible for diamonds to have regrown in the last billion years. Again, it's just very early days. They've staked a couple dozen similar but smaller low mag targets, which were always ignored in the past, and they're going to poke holes into them, and maybe some of them turn out to be hydrothermal breccias with other minerals in it. Maybe they turn out to be kimberlites, but you've got a fantastic story, and they won't know until the first quarter of next year if we have another diamond play in our hands, and of all places, the James Bay lowlands once again. So thank you.